It's Brian Preston, the Money Guy.
Anthony out on YouTube, he asks, what types of investments should go into each of your three buckets? If you've been listening to the Money Guy show for any amount of time, you might have heard the guys talking about the three tax buckets. And when you hit like step 7-ish of the financial order of operations, that's when they start talking about that. So what types of investments should go into each of your three tax buckets?
Mr. CFA, would you like to take this first?
Yeah, sure. So first you have to acknowledge when it comes to building assets, there are three distinct tax buckets that you ought to know about. There are things that we're familiar with that grow tax deferred. Most of us know this as like regular IRAs or maybe our 401k at work. Those are great. We put money in now, we get a tax benefit now. The money grows tax deferred, and when we pull it out later in life, then we pay income tax on it. So that's pretty good. Well, then there's like this supercharged awesome bucket where we don't get a tax benefit now, we put money in, it grows tax deferred, and then when we pull it out, assuming certain qualifications are met, it's completely tax-free. So we have a tax deferred bucket, we have our Roth tax-free bucket or HSA tax-free bucket, and then we have our third bucket, which is after tax, meaning every year as it grows, we pay tax at favorable rates oftentimes on those dollars growing. Well, if each one of those buckets and the things inside those buckets are taxed differently, we probably ought to have some thought process or some sophistication around what are we holding in each bucket. Now, I want to put a disclaimer on here before I give you the answer. This is sort of like advanced level. This happens later on in your financial journey. If you're someone who's just starting out and you are just beginning to wade into the waters of building wealth, I don't think that asset location, where you hold which type of assets, should matter a ton. You should focus on how much can I save and how can I save more? How much can I save and how can I save more? Well, then once your portfolio reaches a critical mass, maybe that's $300,000, $400,000, $500,000 of assets, then you can really start benefiting from asset location, what types of assets to hold in which types of accounts. So, for thinking about tax deferred, Brian, we don't pay income tax on it now, but we pay income tax on it later. So the things we want to put in there are the types of investments that are going to generate ordinary income. For most of us, these are things like bonds or fixed income investments or investments that have a high ordinary income yield component because we want to receive that income, but we don't want to pay tax on it. So that's what you'd hold inside of your pre-tax 401ks, inside of your traditional IRAs. Inside of your Roths, this one gets a lot more exciting. What do you hold in your Roths?
Yeah, this is where we want to take advantage of the fact that tax-free growth is so powerful. I get it so excited thinking about tax-free millionaires. So you definitely want appreciating assets. But you got to be careful. You don't want to put something so speculative that if it goes to zero, you just lost out on that opportunity to get all that tax-free growth. So that's why there does need to be a balance. Be aggressive, but don't be so out there on the aggressive spectrum that you're basically throwing penny stocks in there that are going to go to zero, because that doesn't make sense either because you don't get losses. So I do like aggressive type holdings. I like my index funds, equity funds in those Roth accounts. But then and then when you get to after tax, realize because all this is built on the backbone of diversification of different asset classes, but also the diversification of the tax treatment. And as you've already covered, the tax deferred, when that money comes out, it's going to be ordinary income. So put the ordinary income assets like the fixed income, tax-free, put the growth assets. When you tax, the after tax, realize dividends, they get taxed at a better rate. Long-term capital gains get taxed at a favorable rate. So you want to have those type of assets. So that's once again lending itself towards equities. And never forget your liquidity needs to be in those after tax. That's your cash reserves. Those type of things are going to be built there. That's why this is more of a complex strategy. I love that you gave that disclaimer because I think a lot of people, especially financial mutants, we're so serious about going through our checklist and making sure we get it. That's why I love the financial order of operations, because there's a reason this is step 7 of 9 with, hyper accumulation, whereas you got to make it through a lot of other things. You got to make sure you got the cash reserves. Yep. You got to make sure you've made it through the Roth funding, the fully funding your retirement accounts. Step 7 is where you really get into the nuance of maximizing what that retirement picture looks like and that asset allocation with your tax location.
Now, can I just throw one more thing on there? Is that okay? So obviously, we've given you sort of some general ideas around asset location. But one thing that you have to recognize is that when it comes to your specific portfolio and your specific financial plan and your specific goals, some of that might change. For example, let's say that you are part of the FIRE movement. You're someone who's looking to retire early before age 59 and a half or before 55. As you start thinking about how that third bucket, that after-tax bucket is allocated, you may not just want to have those qualified capital or qualified dividends or capital gain type assets. You might also need to have some stable value type assets in there. Perhaps because that bucket's so big, you need to hold some fixed income in there, but maybe you don't want traditional fixed income. You want to hold maybe municipal type fixed income that has a tax-free component in there. As you get closer and closer to retirement or closer and closer to financial independence or closer and closer to needing to utilize these dollars, you want to make sure that you have a plan in place that is custom designed and custom fit for what you are hoping to accomplish. And we think that's one of the key areas where it might make sense to take your relationship to the next level. If you've not checked out what we do in our day job, you can go check out aboundwealth.com. We have a number of advisors who'd love to learn a little bit about your situation and tell you how you might want to move from a general solution, general portfolio, general plan into a very specific personalized plan for you.